The challenge begins. In this lesson, you'll meet Dane and Albert, two new traders finishing up their first week of training. Your challenge? Use what you've learned in lessons 1 and 2 to help them make smart trading decisions. Are you ready to put your skills to the test? Let's dive in. Your first challenge begins now. Class, meet Dane and his partner Albert. Today, Dane is following Albert through his very first week in the markets. He's a brand new trader, just like you once were. Your mission? Help Albert make smart, strategic decisions using everything you learned in lessons 1 and 2. Are you ready to test your skills? Let's get started. Day 1. When should you act? Let's break it down with Albert. Buy when prices are likely to rise. Sell when you want to lock in profits or avoid a bigger loss. And hold when you believe there's more room for growth. Because in trading, timing is everything. Challenge question. A stock goes down 2 days in a row. Should you sell or hold? The answer is false. Pullbacks are normal and should be expected. Unless you have unexpected news that could tank the stock, consider holding. Let's clear this up. Just because a stock goes down for 2 days doesn't mean it's time to panic. Selling on emotion without a real signal can cost you in the long run. Smart traders know the difference between a dip and a true reversal. Look at this chart. After 2 down days, the price rebounded and kept rising. So remember, it's not just about what the market does. It's about what you do next. Remember in lesson 1, we defined trading as buying low and selling high. Smart traders and investors love a pullback. Stocks typically move upward twice the distance as the dip. Great traders sell with signals, not with panic. Day 2, acting on impulse. Look at Albert. He's pumped from yesterday's lesson. And now he sees XYZ stock going up for 3 days straight. Afraid to miss out, he dives in and buys. No real plan. No research. Just hype. But here's the lesson. Trading based on emotions, like fear or FOMO, leads to poor decisions. Smart traders take a step back, analyze the move, and always plan their entry and exit. Impulse is not a strategy. In what order should Albert have followed his plan? Type your answer below. Smart traders always follow a plan before buying. Research why price is moving. Set guidelines to manage risk. Define when to take profits and set a stop loss. Let's be honest, Albert wasn't trading, he was gambling. He chased price without a real plan. Smart traders know exactly why they're entering a trade, when they'll exit for profit, where they'll cut losses if they're wrong, and how much to risk from the start. Trading without a plan? That's not strategy. That's just hope. And hope is not a winning method. Day 3, liquidity. Albert decides to buy 1,000 shares of a small tech company. But as he places the order, there aren't enough sellers at the current price. By the time his trade goes through, the price has jumped and Albert ends up paying way more than expected. This is a classic case of low liquidity. When a stock has low liquidity, there aren't enough buyers and sellers to fill big orders at stable prices. The result? Slippage. Your trade gets filled at a worse price than you planned. Liquid stocks like Apple or Microsoft have lots of buyers and sellers. Prices remain stable and trades happen fast. But illiquid stocks, like some small cap tech names, have fewer participants, which makes your trades riskier and more volatile. Let's test your understanding. Match each stock type with how its price reacts when there's a large order in the market. Here's the correct match. High-volume stocks barely move. Mid-cap stocks shift moderately. And small tech stocks, they jump fast. Now that you've matched the concepts, let's apply it to a real trading scenario. Albert wants to buy 1,000 shares of a small tech stock after reading about it online. He places a market order, but before it completes, the price jumps significantly. Why? Because the stock has low liquidity. Just a few buyers are enough to quickly move the price. That's liquidity risk. Day 4, trading styles. There's no one-size-fits-all approach in the world of trading. Just like athletes choose sports that match their strengths, traders must find a style that fits their personality, schedule, and goals. Some traders love the adrenaline of quick moves and make dozens of trades a day. That's day trading. Others prefer a calmer pace, holding positions for days or weeks. That's swing trading. And some, like long-term investors, focus on the big picture. They don't watch the charts every minute. They build wealth over time. Today, you'll discover the different trading styles, and more importantly, which one matches who you are. Ready to explore your trader identity? Let's go. Albert's getting sharper. As he gains experience, he starts noticing a pattern. ABC stock often rises for 2 to 3 days right after a strong earnings report, then drops back down. So Albert builds a plan around that. He decides, I'll buy right after a good earnings release and sell within 48 hours to catch the quick move. But trading style, it's not about guessing. It's about observing patterns and creating a plan you can repeat. Now it's your turn. Albert is starting to understand his personal trading style. Look at the 6 options and try to identify which ones match Albert's approach. Pause and take a moment to decide. We'll reveal the answers next. Great job. Albert's trading style is becoming clear. Focuses on fundamentals, he follows patterns, and catches short-term moves. These clues point to a short-term swing trader who acts on both price action and company data. Keep practicing. Understanding your own style is key to consistent results. Day 5, managing risk. Albert decides to diversify his portfolio between bonds, commodities, and stocks. Let's match the concepts of concentrated versus diversified portfolios. Diversified portfolios, these include a variety of investments, often deliver more stable performance. Concentrated portfolios, which focus on just a few assets, can bring bigger gains, but also bigger losses. Diversification is a key risk management tool. It protects your portfolio from a single asset crash and helps you stay in the game long term. Let's check the answers. A diversified portfolio typically delivers more stable performance over time. By spreading your investments across sectors or asset classes, you reduce your exposure to any single risk. On the other hand, concentrated portfolios can lead to bigger gains or bigger losses. The risk and reward are both higher when you place all your bets in one place. And finally, the concept of diversification itself is designed to protect your assets from the crash of any single investment. It's like building a safety net into your strategy. You got it. Diversification is all about managing risk by spreading your investments. It helps you stay safe, stay steady, and stay protected. Great job. You've helped Albert through his first full week in the markets, and along the way, you learned the essentials. Trade with clear reasons. Plan your entry and exit points. Check liquidity before you act. Split orders for better fills. Match your strategy to your time frame. And of course, diversify to control risk. These basics are the bedrock of smart trading. Keep showing up, keep practicing, and we'll see you in the next lesson. Congratulations, you've officially completed week 1 of the Trading Fundamentals Challenge. This foundation sets you up for long-term success. Be proud of your progress and get ready, because week 2 takes it to the next level.